If you're a self-employed person and you have a corporation, let's say you make $500,000 in a year in your business and you pay yourself just $100,000. You've got some expenses to pay and other things. Let's say that you still have an additional $200,000 that you've made in your business that you could pay yourself. But if you did that, you would end up paying 50% tax on that. What most people who have a corporation do, they'll take $100,000 that they actually need to live on, and the other $200,000 they can keep inside their business. That's called retained earnings. When I go to a bank to qualify that client, I can of course use the $100,000 that they paid themselves. What many people don't know is we can actually use the company's retained earnings as income, as if it was paid to ourselves. And it depends on the lender, but we're able to use anywhere from 40 up to 100% of those retained earnings. Even though this business owner only paid themselves $100,000, because of his retained earnings, we could potentially use $200,000 or even $300,000 as income. Instead of getting a mortgage for $500,000, it might be $1 million or $1.5 million. It's a tremendous difference for those business owners. I'm raising this because we've come across clients who were put into secondary alternative lender B products, which are totally fine, but they just weren't aware that we could demonstrate retained earnings that we could then actually move them over to a major bank. Just to clarify, you need to have at least a 2-year average on those retained earnings for self-employed people. So if you had a bad year last year and a good year this year, just know they're going to take the average of the 2 years.